Welcome to this presentation of the Opportunity Zone Meetups. My name is Carl Dakin. I have a consulting company called Dakin Capital. My primary work is involved in designing and managing capital campaigns of any shape, size, or form. And the Opportunity Zones is an area of particular focus to me right now, as a lot of the people, particularly at the community, are asking my assistance in trying to figure out how to shape up and fit a campaign to take advantage of this to improve their communities. I also lead projects and C-level teamwork with a variety of things, and then do educational training for entrepreneurs. So I'm teaching at DU currently, and also we'll be starting a half-day workshop series on business growth strategies. And then I'm leading this particular Opportunity Zone meetup. That's my background. I'll let Lucas introduce himself and his situation.
My name is Lucas Marquardt. I've been a small business finance guy for most of my career. It was only when I met Carl 5 years ago that I realized what I could be doing, and I feel like I'm a pretty smart guy, but I have a hard time keeping up with how fast his brain works. But the bottom line is entrepreneurial finance is a field that is challenging, requires innovation and thinking outside the box to get some of these deals done. As John will tell you, small businesses and the like are typically the most unfundable businesses that you can come by. So it really does require different approaches to getting deals done. I've enjoyed working with Carl on a number of different deals, and now I've got 4 or 5 different companies that I'm either the CFO for, finance manager for, or leading capital rounds for. And there's just so many different ways in which opportunity zones apply to those different businesses, and I'm excited to be here and share that with you.
John?
And I'm John Carter. I've been through a few recessions in the banking business, and now run a company called Denver Banker that introduces quality business clients to the community banks you don't see advertised on TV. They're not the ones who have the ability to reach out and have 4 or 5 people come by and see you every year. They pretty much limited staff, but a tremendous amount of ability, and a lot of personal attention goes into the care of each customer. So that's kind of my specialty.
Okay, great. So we'll get into the program here. We're going to talk about opportunity zones, and tonight we're going to talk particularly about the issue of capital stacks. And for those of you who are not familiar, essentially a capital stack is any 2 types of capital that you put together over time or in a single transaction to achieve a particular outcome. Almost all of you have dealt with multiple capital stacks in your lifetime. Every time you bought a car or a house, you had to put down part of your own money in order to qualify for the mortgage that is behind that. That's 2 types of money from 2 different sources. That's a capital stack. So you're all veterans at this. We're just going to talk about other combinations, dealing with opportunity zones as being one of the sources of capital, and then 1 or more other types of capital that might be brought to bear to make a deal work out where otherwise it might not work out, or to reduce the cost of the money so it achieves a higher ROI or achieves a particular outcome. So I'm going to do a little background here on just to set the stage properly. Opportunity zones is a tax incentive created by federal legislation that only applies to federal taxes as it now stands. And there are 3 primary benefits that come from opportunity zones. One is that you've earned income capital gains on the sale of a capital asset ordinarily in the next tax cycle. So for right now, if you sold a capital asset in 2018, come April 15th, you'd be expected to pay capital gains on that. If you take that same money and roll it over into an investment in a qualified opportunity zone fund, which in turn will invest in an opportunity zone business or property, you get a deferral of when you have to pay that tax. And that deferral will last until the earlier of whenever you come out of that particular project, or 2026, whichever occurs first. So if you invest today, you have about 8 years before you would have to pay taxes on that, unless you liquidate and sell that asset at which before 2026, so you'd have to pay the taxes at that time. The actual opportunity zone benefits go on to 2046, but the deferral ends in the year 2026 unless we see new legislation. The second thing is then a reduction of that capital gains tax. So if, for example, you had $100,000 of capital gains and we're going to have to pay taxes on that by 2026, if you leave that in an investment for 5 years, 10% of that tax liability is reduced. So you get an automatic benefit in reduction of your taxes 5 years out. If you leave it in for 7 years, you get an extra 5% or 15% reduction in your taxes at that time that are rolled over from the sale of the initial capital gain sale. Now, then when the money's rolled into a fund, it creates a new investment. It starts a new clock ticking. It's a new investment altogether. And if you leave your money in that for 10 years, then at that time, any gain in that investment is tax-free. And by comparison, whatever gain you get from deferring your capital gains taxes, whatever gain you get from reducing the capital gains taxes originally, it's quite possible that the amount of tax savings on the 10-year hold will dwarf anything else. So when we look at the clock that's ticking on capital gains, a lot of people want to get their capital gains in place by the end of this year so that they have the chance to qualify for that 7-year time period and get the maximum deduction that's there from their capital gains. But even if they don't get it done this year and they get it anytime up to 2025, they still have the ability to get the 10-year value. So keep that in mind as you're looking at different projects, whether or not what you're saving and hitting the 7-year mark is important or not in the whole scheme of things. But for the moment, we consider this a mad scramble because there's time clocks all through this laws and legislation, and maximum benefit says you need to be invested by the end of this year. However, if you invested, if you had a capital gain from last year, you have 6 months from whenever you had to recognize that capital gain in order to roll it over into a opportunity zone fund. So if you sold the property directly and last year, 6 months ago, was when you did the sale, you may be coming up against the end of your 180-day time period. And you need to make that investment before it's over into a fund that has been registered with the IRS. If you are just getting your 1065 return, which has capital gains in it, it isn't until you receive the return that you have to recognize the capital gain. You have 6 months from that time frame. So this can very easily get a little bit complicated on when did you actually recognize your capital gains, when do you have to put the money back to work. Once it's invested into a fund and the fund launches, the fund then has 6 months in which to put that money to work by investing it in a business or into a property. And in any event, it has to be 90% invested by December 31st of the end of the year. So a lot of you may have seen a lot of talk about opportunity zones last year, and then it stalled out because everybody suddenly realized if they raised the money and didn't have it deployed by December 31st, they'd be stuck. So they all shut that down and went quiet, and now they're all putting money into funds, and then their six-month clock will start in which they need to put the money to work. But you'll see the same thing at the end of this year. As you get to the end of the year, you'll see less people raising funds or trying to do new funds that are general purpose. A lot of the people I've talked to have told me that they expect that dedicated funds, ones created for a specific business or a specific property development, are probably going to be the dominant form in this area. But we'll see how that turns out because the large money managers who are trying to get the maximum gain on stuff for their clients and the money under their control, they're not the people who typically put together projects. So we're have a bit of a dichotomy between those who are money managers, who are probably going to do more general purpose and look for deals, and we'll have to watch the clock all the time. Put as soon as the project's ready to go, and disperse as soon as they do that. So this is sponsored by me. We are open to other people sponsoring this particular event. If you have an interest in getting your name up here and all the materials that are distributed, please let me know. We're doing single events, sets of events, or the whole year, and get your name up here where other people can see it. Right now, as of this morning, we have 108 members in this group. We're climbing about 5 per week, and hopefully that'll continue to grow. We published the video on YouTube, so the visibility is technically nationwide to as many people that see that as possible. And then we create a guide and a slide deck for each program, and everyone here will get a copy of that digitally within the next couple of days. If you haven't looked at all the old videos, if you go to YouTube under my channel, Carl Dakin, you'll be able to find all the old videos, and the conference videos for the Bridge to Opportunity Conference will be up online tomorrow from that program that we did in November of last year. So more and more information as we build our library and make more resources available to you. But the slide is in here to remind you that I am looking for sponsors. Okay. Colorado has 126 opportunity zones. There's about 8,600 nationwide, including the territories of Puerto Rico and Mariana Islands and so forth. I haven't had a chance to look at those yet, but Colorado, and I give credit to Stephanie Copeland, who is the former head of the Office of Economic Development, and her staff, including Jana Persky, who worked very hard to take advantage of this, to figure out where they're going to select the opportunity zones, and to try to do a good job of spreading them across the state. So about 60% of these are outside the urban area, 40% in the urban area, and there's projects everywhere. I mean, because they did such a good job, I think we're in an opportunity-rich area. And then they have been promoting this and building a library. And they just started, and I'll have another slide at the end of the slide deck, where they've set up a matchmaking online service for both projects and investors. We'll talk about some of the nuances on that. But brand new service, first of its kind. I've never seen a state do this before. I'm so jazzed about the state of Colorado and what they've done here because it's very, very helpful to us in the community. But this is a map which shows all the areas, and some of the areas are not visible in the map this size because they're microscopic until you zoom in on a particular area. But then we have whole counties, which are areas. So there's lots of opportunities out there. The impact of opportunity zones, we've been mentioning this. It can, the state took a position. They were going to try to make good areas better. They weren't going to try to make bad areas good. And the same way with your projects. If you have a project that is really an ugly project, you may not be able to fix it with opportunity zone money. The increased ROI will make it more attractive, but if it's still competing against everything else that's better than it, it may never get to a point where it's attractive enough. And that's where we've talked earlier about innovation, talking about new forms of funding may be necessary, and public-private partnerships to elevate a project to the point where it is fundable with opportunity zone money and makes it work. But we use this sign from an amusement park attraction. If you're this high, you can't get in. If you use opportunity zone stacks in your shoes to make yourself a couple inches higher, you will now be visible. And it's amazing in the capital industry how a slight margin increase in your ROI will open you up to whole new audiences of investors that couldn't see you before and would not consider you a legitimate investment. Going the wrong way. This was kind of the topic we talked about last time, is innovation, and Lucas spoke to it a moment before. Doing the same old things the same old way will probably result in creating distressed economic areas, which we're now trying to fix. So it only makes sense to consider the possibility that doing things differently could have a different outcome and will not only address and benefit the areas that are supposed to be benefited by this law, but it also may create some better outcomes. And one of the points that I have made is that this gives a community a chance to catch up to all the more affluent communities, but don't stop there. This gives that community a chance to get ahead. So if a community is looking at opportunity zones over the long term, think about where they need to be from an economic development standpoint 5, 10, 15, 20 years down the road, and try to aim for a point that will leave the community in a superior position rather than an inferior position, and don't just try to catch up, try to do better than that.
Are you going to speak to how that protection, maybe from gentrification?
Yeah, we'll talk about that when we get into housing more at the back end of the program. But if you have any questions along the way, please feel free to ask. So the purpose of this meetup is 3 parts. One, we're going to share information. Anything we can find, we try to get out to you, so we'll post it up on the meetup site. If you go to the discussion tab on the Opportunity Zone meetups, every time there's a new article, there was a letter sent by several Congress people to try to expand the opportunity zones that's now under consideration. We'll just post it up there. So hopefully it's one of the better spots, if not the best spot, to get information. We are competing against some major national law firms to be best, so I don't expect I'm going to win all the time, but we're going to give it our best effort to have a really good site. These programs we're going to try to do as case studies where we try to dive into a particular project. Tonight we're going to kind of go horizontal, look at several types of projects from a capital stack. But the idea is the deeper we get into the project, the more we'll surface what we don't know. We can address it, fix it, and maybe come up with a solution or a workaround. And then occasionally we'll come up with an issue that we don't know the answer to. And then, as I said, we'll reach outside of our group, try to find somebody else who is more on top of this or may make this an area of specialty for them and get them involved. So tonight, capital stacks is the subject. These are our panelists, which we've introduced, myself, John Carter, and Lucas. And the question is, where do opportunity zones fit in a capital stack? So I've created this chart to try to my vision of where we're at. I will tell you that I'm still struggling between sources of capital and types of capital, getting them into a single two-dimensional drawing. But as you look at this, you're seeing on the green are different other types of capital. We have debt, which is in the blue column for the most part, and then the red column is equity. Opportunity zone investments are equity investments by their nature. They're either buying stock or they're buying the property directly. They cannot be debt instruments coming out of the opportunity zone fund into one of these. It's got to be one or the other. You'll have certain people like angels or people who work for you on your team with deferred wages, which cut across all 3 of these spectrums, so it can take any form of capital. We have every form of debt in the middle that's there. And then the things on the side are things like selling your product up front, doing technology licensing, doing in-kind assets, grants, gifts, and things of that nature. So if you're in a nonprofit, you may end up combining a gift over here and combine it with equity over here to come to your combination in order to get there. So this is an effort by me to try to say that it looks like opportunity zones coming into the business life cycle of a project can come in pre-revenue, right time, right place, right investor will be willing to put money to work before this business has earned any income at all. But most of it's probably going to be somewhere in the pre-profit area where they're generating revenue but have not become profitable. This could include a high growth company that's doing great but still not making any profits. And then obviously once the company matures or the property matures to a point where it's generating a profit, it would still qualify for certain opportunity zone funds who are looking more at a late stage, low risk type of proposition. And what I'm anticipating is that wealth managers, and Ty, correct me if I'm wrong here, but going to be a little more conservative. You're going to see the riskier stuff coming from individuals, from angels, but once you get into money management and institutions, it'll be a little more conservative than the individual style investments. Would you agree with that? Ty, who works with a money management group and has established a fund, which they're now looking for deals in the real estate development area, has expressed that you may see more, I'll call it risk-taking, because it is house money as opposed to money that's under tighter management. And so again, depends on where you're looking. All money has different flavors, and the person who makes the decision can't have as many different flavors as there are people who make that decision. So be careful not to make too many assumptions on the style or preference. I always ask people to tell me what they want, and then I'll continue to ask and verify that until I get comfortable that we're both talking about the same thing. So timing, did I skip a slide? No. I'm getting used to this as a thing. Timing means that the money may come in at different points. So as an example, one of the projects we've looked at is the Sugar Beet District project that's being set up by Net Zero in Fort Collins. This is a large $240 million estimated project in size, and it can be funded in 3, 4, 5, or 6 stages, depends on how you want to put the deal together. If we had a single lump sum, large scale opportunity zone fund, they might fund the entire thing in a single funding. We'd have a single transaction and take down $240 million, which would cover everything. The more classical approach, which we are anticipating, is that there will be a round one of about $8.5 million that would acquire the property and do the engineering to make the thing shovel ready. That grossly reduces the risk, which makes it more eligible for a second tier of funding, which could also be opportunity zone money or EB5 money or regular debt financing, which would then build in the infrastructure. And then in stage 3, this is an invitation-only development, so only tenants who have been specifically invited to participate, trying to create a complementary set of tenants, from a brew pub to a hotel to hops grow house to a cannabis grow house. They are all individually fundable. They could be individual capital campaigns through opportunity zones, or there may be someone who wants to put in a tier of money for all of them and float all the ships in the harbor. And so we have several ways of coming at that. So you may see different money coming in at different time. It's not likely that it's going to be the same fund because you're on different time zones as you put the money into work. So we might see this year stage 1, next year stage 2, the following year stage 3. And so 3 different capital raises or 3 opportunities for opportunity zone money to work. We may also see opportunity zone money serve as a foundation. This is a down payment. I talked about a common capital stack. You put down 10% on the car, then you borrow the other 90% from the bank. There are a lot of loan programs, and John can speak to this in more detail, where there's all kinds of government guarantees once you hit a minimum equity threshold for that particular type of a deal. The opportunity zone money can do the heavy lifting and serve as the down payment that sets the table for you to go after classical debt funding at a lower cost of money for the bulk of all the money that you may need. This allows you to leverage the project. By leveraging the project, you can enhance the ROI for the investors with the additional money. The only caveat I would add on that is we're watching interest rates rise right now. You may find that doing the entire project with opportunity zone money may make sense, or 2 types of opportunity zone money, where one is doing the heavy lifting, higher risk, or you pay a higher ROI, then you chase that with a second opportunity zone investment that is a lower risk, more patient or different type of capital, but do the whole project because the cost of interest for some certain sources is high enough that you may find investors who are happy to have this with the tax benefit rather than doing it part equity and part debt. Opportunity zone money may also be the seed capital. meaning that it's the high-risk, scary type of money, but they're not all opportunity funds are likely to do that. This gets into a tech startup like Lucas and I work with a lot of times, where it's a brand new item, never been sold before. The technologies may not be fully built. It may be dependent upon a number of things, so it's going to be high risk. And still you may find a group of investors through Opportunity Zone investment who would match up with that and then look to other investors or other types of capital as the whole project matures. And then jobs. What we're shifting now to is some of the objectives that a community may look at for Opportunity Zone funding. And talking to lots of communities across Colorado, they all need housing. We're going to talk about housing in a moment. But the thing is, there's no use building housing if there aren't jobs to create wages to pay for whatever the house is going to cost. So I typically, when I'm talking with a community about what they're doing, I start looking at the jobs first, and then we look at infrastructure, or then we look at housing or training or one of the other major things that a community may need in order to make this all work better. But jobs is the big deal. So Lucas, I know that you and I are working on some projects. I would like for you to kind of share your thoughts on where you see an Opportunity Zone investment might have the greatest impact on creating jobs in a community.
The businesses that I work with are manufacturing businesses, and as we all know, a manufacturing floor is a pretty popular place to be. And when you go to start up a business or move a business or fund a business, if it's within an opportunity zone geographically and that qualifies to be funded through a qualified opportunity fund, not only are you bringing the business itself to that zone, which typically is not one that has a lot of jobs for the people that live there, you're now creating factory jobs for people to come in and earn that money and spend that money within that community. So it has kind of an ongoing effect within that community because you're creating the jobs, and that's, I think, the first thing that comes to mind.
Okay. John, your thoughts on how opportunity zones might help create jobs?
Well, the opportunity to have people working is a big deal for both communities and the government in general. So there's a lot of incentives in the audit world for development of projects that will create employment. That said, there's not a lot of opportunity in the audit world for funding for the housing that would house those workers. So the opportunity zones really play hand in hand with the audit types of funding.
Yeah, so and I will point out that, again, thinking about capital stacks, there are lots and lots of government programs out there that are also aimed at economic development and specifically in job creation. And in some cases, we've seen the Department of Commerce, Economic Development Administration has a number of grants for community block grant development and other things that are there that community can draw upon for economic development reasons. It all doesn't have to go to housing, which tends to be where a lot of it is spent. You can go into the USDA and look at different programs for setting up community facilities, different types of infrastructure pieces, and all those monies are there. And then you then start combining those kind of programs with Opportunity Zone money, and it greatly enhances the range of type of activities you can get into, the cost of money as it balances out over the total cost of the project. So it can be quite large. What else?
Well, I was just going to mention that a friend of mine started a brewery called Brewability, and she's recently opened up Pizzability as well. And the whole premise is that in this business, they're employing adults with special needs. And besides the fact that the beer and the pizza are fantastic, they're also able to qualify for grants for employing those individuals, and it's become a very viable business model for her, and she's hoping to franchise it across different cities. But you couple those grants with Opportunity Zone funding in an area that now you're just kind of multiplying the community effect that you see.
So housing, as I said, I haven't met a community yet that isn't short on housing. They're either short of inventory, they're short of quality housing. The housing is at a standard that people are unhappy with. It's being its own drag on the local community and on the local economy. And so we're seeing everything from single-family residents to multifamily. We're seeing mixed-use developments where housing is coming into play. And again, there are specific programs out there today, both charitable and government programs that are there to help with housing. With the Opportunity Zone money coming into play, it can help make the down payment. It may remove some of the risk for infrastructure. It can do other things in combination with that housing that might have been the missing link. So I would say a lot of the projects right now are shovel-ready or near shovel-ready projects where somebody's been working on it for a while. They've been knocking down the issues one at a time, but very slowly because they're probably bootstrapping the project. And now suddenly this new source of money shows up that can elevate this project to make it visible with a higher ROI. And people are going, yeah, this could work for me. So in that regard, I just see this as yet another area where an Opportunity Zone investment coupled with other types of money or grants or programs can suddenly make a program work. And I've been doing a lot of exploration in the area of equity share, where you have a project such as we have with Brown Equity Properties where they're going to renovate houses, single-family dwellings for the most part, within communities of color. They're going to use part of the appreciated value coming out of the sale of that property to help with the down payment. So they're moving renters to owners by doing it in this fashion. We've seen other models where Stapleton, when they redeveloped it here in Denver, they split the property from the building so that the total cost of the structure was reduced, which would make it more affordable to people at a lower price point of entry. We've had discussions with people about taking a percentage of the rents of an apartment complex, which would go head-to-head with affordable housing and allow people to earn wealth in the business or in that property over time. So it's an undivided interest that could set up like a REIT or in some form of common ownership structure. And then there's been even more conversations about further contributions to either the down payment or payments over time. And the part of the problem there is that some of these programs are not going to match up with existing mortgage industry. You want to talk to that a little bit, John?
Yeah, the government's very parochial on what kind of loans they will make and what kind of definitions they got to fit into. A lot of times you will find private institutions doing what they call program finance, where they, I remember back in the days when we converted a lot of the apartments in Denver to condominiums, they didn't meet the condominium standard for FHA financing. People would come in and provide that long-term financing for those units. It would have a little higher interest premium, and in 3 to 5 years would come due in the hopes that enough owners would occupy enough of the project to qualify for the FHA financing.
Yeah, so again, a little creativity, different types of money from different sources can make this all possible, where before you might have hit a wall. One of the things I was told that the Freddie Mac would not support a three-way ownership of a structure. So where I'm talking about having an Opportunity Zone as a part owner, that would not automatically work. So we started talking then to employers about buying the houses and holding the title, where they would go through original financing, meet the requirements, and then they would allow employees to earn essentially a right to buy that house at a time or discount in the future that would serve to buy this down and make it affordable to an employee, and at the same time bolster the relationship with the employer. Because if you're trying to maintain your job in order to get your house as one of the perks of employment, that's just a stronger employer-employee relationship.
Is it possible that an opportunity fund that's funded well enough could essentially be making private mortgages to in a community like that where there isn't a bank
That's
involved?
kind of what they did back in the condominium days. They would make those private mortgages and then they would sell those pools off when they became FHA financeable.
Yeah, so the concern there is you're not allowed to make a debt instrument out of the fund directly, so the money would have to roll over into a opportunity zone business, and then that opportunity zone business has to be, again, concerned with how they're operating it to remain inside the rules. So there are some restrictions as you get into financing and funding in an opportunity zone business that I don't have all the answers to tonight. But there should be different ways in which that property can be acquired. It can be enhanced. It can be made available to people in lower incomes, assuming that they have enough income in which to make this all work.
So thinking outside the box here, if the opportunity zones went in and bought a piece of land and actually did the development to create these homes, and essentially the fund is making an equity investment in this housing, and then the tenants would eventually somehow purchase equity bit by bit, is that something that loosely we could possibly do?
Yeah, that should be done. And in fact, one of the challenges I've seen, I had a lot of people come to me with real estate classical development projects. They'll come in and buy the property, enhance the property, sell the property off, and that might be a 2, 3, worst case 4 or 5 year cycle in order to do that. That's not the 10-year life that you want to look for in an opportunity zone. So what we're seeing people is move from that last flip, instead of selling the property off and creating a exit point for the investors, is they're moving into long-term leases. So they become a commercial landlord that'll continue to rent over time, which gets the 10-year cycle. You are going to be generating rents, which are ordinary income coming into the property, which is also helpful, so that when you get to the 2026 timeframe in which you need to pay the deferred capital gains taxes, there's actually cash there that's available to the investors to make those payments. So you get a benefit there as well. But yeah, we're moving away from a build and flip, throw it over the wall, somebody else's issue down the road, to a build and hold long term in order to make the full benefit of this. And it's still possible, though, that you may want to go to a particular type of investor and do the front end investment with a classical investment, give them a higher ROI where they're, again, doing the heavy lifting, getting the building built, and then roll that into a long-term opportunity zone type of a hold as a business where you're generating rents over time, and then the property's appreciating over time. And you'll have to be careful to roll that over in terms of equity as opposed to a resale, because any property that's fully finished and fully developed, if you flip that as a property, an opportunity zone is not going to be able to make the 100% investment enhancement to that property in order to make it work. So you're going to have to do it within the framework of selling the equity in a business as opposed to a land sale. Yes?
How would you see the exit on a scenario like that, like a lease to own the long term? How do you see the exit, or would you have to be a corporation and sell stuff, or and if you have multiple assets, right? How do you deal with the exit?
So two questions are being raised. Is one, how do you get, if you're an investor in an opportunity zone fund, it's invested in a property or business, how do you get your money back? And in some cases, it's a very simple model where you're going to enhance the property, sit on it for your 10-year time period, and then sell the property, and everybody takes their cash and goes home with the tax benefits. In other cases, they may have put the money into a business. The business is still operating. It's doing fine. The business is going to have to plan for an intentional exit. Usually it's going to take the form of a capital raise campaign that's after the 10-year time period has finished. And as that money comes in, it's for the specific purpose of buying out or buying down the opportunity zone investors, so that there is a specific event and a cash transfer that takes place. So that's what we're pretty much anticipating. Now, if I'm an investor investing in a particular business, I'm going to want that built into my contract. So my investment agreement says somewhere down the road, either automatically or by vote of the majority of these investors, we're going to do a call on this project, and we're going to want them to then complete an equity campaign to take me out of the deal. Now, that's assuming that the business is doing well and it can raise money, and there's a way to make that happen, because there's no guarantee on that. But that's the kind of thing that you'd be looking at. Now, yeah, that's to the second part of your question. Question is yeah, if you invest into a fund and then it makes multiple investments in different projects, you've created a very complex management challenge. You can use the same model where you're saying, yes, we're going to take people out of each of these projects. We may try to time them so they're all at the same time, but that's not likely to happen. But you're going to try to wrap that up. So again, you go through your 10-year cycle, you get to the end, and you go, okay, we're going to start selling these assets off as quickly as possible for good value. We may have to do a series of campaigns in order to take people out of individual projects, but we're going to build this into our long-term plan, and we're going to provide for this coming backwards so that there's a way to create an intentional exit for the investors.
No matter how you do it, if it's done through an opportunity fund and the investor's not paying any tax on the upside there, then the actual cap rate and appreciation on the properties doesn't have to be as high as it would if it were to be taxed.
Right. So part of the question that's come up is, okay, I'm in for 10 years, everything's going good. Do I want to get out? Or do I want to wait till the last possible date in 2046 and come out when I've got the maximum gain potential with the maximum tax incentive? And again, this is an interesting question with a great crystal ball question, because at the end of 10 years, everything's going great. You may get out now and put that money to a different purpose, or you may want to let it in, let it ride for another 10 years. So I'm anticipating that we're going to see some more complicated mechanisms built into the investment agreement that will allow one person to come out, because they don't all have to come out at the same time. Some people can stick and some people can get out, but you need to have the capability of doing that either through another capital raise or borrowing money or doing something else.
Well, if the new market tax credit program is any indication, we should see an extension, if not 2 or 3, as that program was. So it might not just be 2026 and that's it. We could see that extended for several years at a time.
Yeah, I've seen some discussion of whether or not there's a potential legislative amendment to the Opportunity Zone laws to allow this to go beyond 2046. And right now I could see legislators going either direction. They want to force an exit. They don't want a forever fund taking place. The money's been invested, and once it's invested in the community, is it still doing good work for the community? Is it having the same level of impact in the community, or has it done its work and it's time to clean up and go to another round of funding? So we may not see that extension, but we won't know this until, in my mind, we're a few years down the road and we're seeing if this is working and what kind of long-term impact it might have.
But to that point, Section 8 or affordable housing, something that has a social impact that can be demonstrated, I think will make the case for extending the program.
Well, extending the program may take a different form, though, and that is that they may say, well, we're going to set up a brand new program with brand new investments, but you can't cross over from one program to the other. Yes, Ross?
So the Qualified Opportunity Fund, if it invests in, say, a housing asset like we've been discussing, can it exit that investment and roll it into a different housing project without distributing the interest within the Qualified Opportunity Fund?
Yeah, so the question is whether or not a investment by an Opportunity Zone fund into a specific property can result in that property being sold and rolled over then into another property. And there are certain, I will say, certain ways that could potentially happen and other ways maybe not, and it's a point that's currently being asked for clarification on to the Internal Revenue Service. And so as an example, the fund is actually the investor in the property. So if it sells that property, that is going to be an event that's going to force a recognition of the capital gains. So right now, I don't see that working. Now, if you invest in a business which is engaging in developing or renovating a series of properties, then the investment is in the business. And so the sale of properties is a normal course of that business, and that won't trigger the capital gains going back, because the capital gains are in the stock of the business, not in the property itself.
So the structure would be for the fund to invest in the business, which invests in the assets. Okay.
Right. So again, the investors have to have a common enough interest when they come into this, an understanding of what they're doing and where they want to come out of this. We've seen some examples where you could start up a business because any short-term or long-term capital gain qualifies, and you might intentionally create a series of businesses and sell those off, generating more capital gains, and then roll those capital gains over into more projects. But every time you do that, you're restarting your 10-year clock. So the other thing to keep in mind there is, what's the clock tied to? Is it to this property or to this business? And if I sell that, even within a rollover, am I somehow triggering an issue of my clock? So take a look at that as well.
I think at this point we've been really looking at putting it together so that the investment fund or the opportunity fund has a specified target, and that is a business, or it's a business and a piece of real estate where the life cycle and the exit strategy is well defined. And we have an opportunity to do that, so it doesn't create a complex management issue where you have different rollovers within the same fund. But that fund with that target keeps it as simple as it can be, I think.
So can distributions be made from the fund to the investors during the year and still be, I mean, does everything have to stay in the fund until the end of the?
Yeah, so the question is can a fund make distributions to the members? And the question will depend to some degree upon how the structural entity of the fund. Is it in a corporate structure, or is it in a LLC or a pass-through type of tax entity? There is every expectation that if it's in a pass-through entity, they're going to have to distribute at least the ordinary income to the extent of the tax liability on that ordinary income, so you don't create an upside-down cash flow. And that's not impacting the underlying investment, so it's not going to have any impact on the appreciation of the asset. That's just dealing with the ordinary income part. If you start selling assets and chipping into the capital at some point, then that's going to constitute a distribution, and then you're going to have to look at that as its impact on the individual investor and on the investment itself. Let's go to the next one here. Commercial development. Some of this is going to follow the same path that we've talked about with regard to housing, but I think we're going to see more creativity in this type of a structure. Similar to the last program, we had a piece of developed commercial property. We looked at an opportunity zone fund to put a brand new building on part of the property, or to buy equipment to put into the property, or to retrofit the building to make it to a more suitable or a more fixed tenancy. We talked about putting housing on the property in combination with this, and we ended up with several different models of what you can do with a commercial property in terms of development, and every one of those can have a different type of money, a different group of money. Could be opportunity zone money or non-opportunity zone money. You can have short-term money mixed with the long-term opportunity zone money. It seems like it gives you a broader canvas with more options on what you can do.
For example, I do a lot of work in the food industry, and there just aren't as many food manufacturing businesses in Colorado as we'd like to see. So the model is not just to buy a building and outfit a building and put one business in there, but to put several food companies in there that utilize the same space and can take advantage of the synergies or the shared services of distribution, cold storage if you need it, back office, all those. That model is something that we're actively working on for more than one company.
John? Any ideas?
Well, in the commercial world, you have a lot more flexibility just by virtue of the fact that it's as creative and as imaginative as the developers that put it together and can demonstrate the ability to repay the loan. So if you have a building and you want to lease the ground out from the owner, you can put the building on top of the leased ground, get financing for the building independently of financing for the ground. There's just multiple different ways to set that up. You can condominiumize the building and have separate ownership for each condominium unit. The structure and the method of capitalizing each of those would just totally vary.
Right, so yeah, I would say that in commercial development, you probably have the broadest choice of options and types of money that can be brought to bear. And the nature of the business or the tenant in the building may open up even more sources. So if I open up an art gallery, I may have one type of money that's available to me. If I'm opening up a better known business, a different type of money, and the list goes on and on. We could be in the hundreds of types of capital, which could make this a very fun project to do with a little more complication associated with it, but it has that capability. And then the last one is infrastructure. One of the things we're seeing in a lot of communities, particularly rural communities, is there's a need for improved water or better waste recycling, or we're finding that putting in a small solar farm or grid may be very easy to finance. And if we then marry that project with a building project, whether it's housing or commercial development, the whole thing may be easier to fund because you have a known source of revenue that a lot of people feel very comfortable with when compared to maybe the other more variable or riskier type of revenue streams. And so the combinations can be more fundable as a group. Any ideas on that?
You know, the idea comes to me is, you know, a lot of these big box stores, Sears, for example, I mean, there's going to be a lot of these large buildings that are now empty and not appropriate for a new tenant. You know, to your point, building infrastructure companies, whether it's a power company or a utility or investing in the land around that, it becomes a very viable prospect with opportunity zone funding.
Well, and I talked to a group who does a lot of energy installations, including working with nonprofits and religious groups, and they'll come in and where they may have a lot of land and put in a small solar farm as a for-profit subsidiary of the charity that stands on its own merit and which can have independent investors into that project. So again, by changing structures and combinations, we've opened up more options for everybody to take a look at. So see, these are some of the questions and challenges that I saw coming up in today's topics. And one of them is whether opportunity zone funding is the best funding or just better than other types of funding, or whether standing alone it really makes a difference. We're also talking about competing with other sources of funding, meaning that if I'm looking for money, is opportunity zone funding going to necessarily be the best price, the easiest to raise? If I'm doing a dedicated opportunity zone fund and I have to manage my own capital campaign to raise a significant amount of money, that may be a skill set I don't have, or I don't want to spend the time and energy to go do that. I may prefer to go shop it to funds that are created by institutions or other things. There are different approaches to raising funding into a capital stack, and you can have private equity campaigns, you can have investment crowdfunding campaigns, you can do something of a more glorious scale, even up into public offerings if you want to go down that path. But your goal here is to get the money in the door and quickly enough to put it to work where you need to. And then one of the questions is maximizing the tax incentives. There have been some questions here earlier about what can we do to make this, realize the greatest gain. This may be that in certain real estate deals, we do want to try to roll them in a particular fashion. In other cases, it's a hold. We may want to use a corporate structure for the fund so that there's less taxes potentially paid over time. But so far in trying to run numbers side by side between corporate and LLC structures for a fund, it's difficult to make a blanket statement, one's better than the other one. You have to look at your project and run the numbers from different scenarios. There may be other things you can do to leverage the money to get a greater ROI for your investors along the line. So what we've found is these are questions that are still going to be asked. You can't answer them until you get down to a case-by-case basis and look at those. And that'll help get you through this. Yes, Ross?
Carl, I'm particularly interested in that intersection of raising funds and securities legislation, particularly if you're raising funds on behalf of partnerships and third parties. Where does that cross over, and kind of where's the line that you just can't step over as an unregistered?
Yeah, so anytime you raise money into an opportunity zone fund, unless it's your own fund, it constitutes a sale of securities. So you're going to have to conform to federal and state law. You're going to have to do your disclosures, file your paperwork.
Unless it's your own fund.
Meaning that if I set up a fund for myself for my own project, to that point it's my fund, and I'm funding my fund. Okay.
You're soliciting from outside your
But
own fund.
once I start taking money from any other person other than myself, then I'm in the sale of securities. Okay. Now, once the fund invests into a business, there's a second sale of security taking place at that point. And if that's not a captive fund, if it's a generic fund and it's making an investment into a business, there's going to be a security transaction occurring there. So there's two at that point. Now, if they're investing into their own business, captive fund, then that second step is not a security sale. If they're buying property, it's no longer a security, it's a real estate transaction. But raising the money into the fund is securities followed by a real estate transaction. So any way you look at it, unless I'm putting my own money into my own fund, it's a sale of securities. So the fund being funded is a sale of securities. Then from the fund putting the money into a business, unless it's my own business, it's a sale of security. If I'm putting money into real estate, then it's a real estate transaction.
So in terms of the sale of security, who do I need on my team to?
So the question, yeah, sure. The question is, knowing that a sale of securities is going to take place, who do you need on your team? There are a number of people who provide this as a service, who can help you put together the deal. Similar to the services I provide or Lucas provides. There are securities attorneys who can handle all the paperwork if you need to paper it up. A broker-dealer, a registered broker-dealer can help you do this because if it meets within their ability to handle it for their firm and FINRA requirements. You have to look again at the individual transaction and ask yourself, who am I raising money from? What kind of securities offering is this? What kind of rules apply? And then you may need 1, 2, or 3 different people to help you walk through. So you want somebody who knows how. You want somebody who can deal with the legal issues, and then you may have some regulatory issues if you're doing crowdfunding or something of that nature in addition to everything else.
What kind of cost are we talking about?
Well, the question is, what is the cost? And as we expressed earlier, if you're doing this yourself at a low end and you've got a lot of your stuff together, you may have already done a private placement, you may have been partly through the cycle of raising capital in a capital stack. You might only need another $30,000, $35,000 to put together a campaign, make sure all the regulatory requirements are made, and spend enough money to attract the money you're looking for. That would be a middle of the road. If you have a project that's beautifully situated for an existing fund, then you go talk to the fund, you have a single investor, and it's a single transaction. It may not cost you hardly anything. The fund may even do most of the paperwork for you, so you may lay all that off. If you have to do a full tilt, build your own fund, raise your own money, build your own relationship, you're looking at probably around $60,000 to $65,000 for a small dollar campaign. That's one in Colorado, $5 million or less. If you do a Reg A Plus campaign at the federal level, that can go up another $10,000 to $15,000 for every $10 million you're going to raise.
So most of those costs are actually tied to the marketing of that fund. And so the more, when we talk about the fund having a target, if you have one step further where you have the investors that are looking to get into that target, in my case, those that want to invest in food companies, The only thing that's missing is an opportunity fund to bridge the gap between the two. That's going to cut down my cost on sheer marketing, so I'm not going out and finding the investors. I've already got them.
Yeah, so it gets down largely, do you have a group of people ready to invest and know who they are? Otherwise, you got to do a lot of marketing. And in addition to marketing, then you're going to have some real estate potentially, some legal issues, contractual, business-wise, and some securities laws issues. And then there'll be a few regulatory costs, but actually the regulatory isn't that big of a deal.
Carl, could you speak to the opportunity for somebody to do a joint venture with an opportunity fund? What would be involved with that?
Well, the question is can you do a joint venture with an opportunity fund? And the answer is yes and no. The opportunity fund has to make an equity investment into a business or a property. That doesn't mean that it cannot team up with another opportunity zone fund and do a syndication of the raise of the money. There might be some other complementary impact where they're doing all the operations for the project within the Opportunity Zone Fund, and they outsource part or all that work to a strategic partner from an operational standpoint. The only thing I would be concerned there is make sure that the money does go through in terms of making the investment. After that, then you've got a number of choices.
The case I was thinking of is a business owner wants to sell his property to move into an opportunity zone and build a bigger business and create more jobs, and partners with an opportunity fund to accomplish that and defer his capital gains on the sale of his other property.
Right. Actually, that was one of the scenarios that came up after last meeting, was instead of holding the property and bringing in an investment into the property as a business, that the owner would actually sell the business to a new group, which could be an Opportunity Zone Fund. And if they do that, there's a limited ability of the original owner to participate. They can't have more than 20% in the fund on the back side. But if that fund is going to raise enough money, make enough enhancements to the property, that's not going to become an issue. But there is a marker there to look at. But the person would give up their control of the property to the fund or to the new business, but they could take their capital gains and roll that over into the new property, cash out what cash they had, if they had any principal, keep the cash, just roll the capital gains, but it then has a chance to follow the property.
I think it's important to note that this is so new that we haven't seen very many of these case studies where people have done anything remotely creative within this space. So, you know, anything that happened here is going to be it's really going to be the first time we've done it, unless it's a traditional vanilla, you know, investment.
Yeah, I mean, most things we've seen to date, the relatively few completed projects were something that was already in motion. It was typically buying an old property and restoring it, or doing a new build multifamily that was already on the drawing board, and it just happened to be in an opportunity zone. So they were able to provide the investors with a greater payback than they would have received otherwise. To get deeply into these communities, I think we're going to have to see the creativity strongly out there to make this all happen.
I mean, if you could kind of put yourself in my shoes in this scenario. I'm a real estate broker. I identify a commercial property in an opportunity zone that qualifies as a qualified opportunity zone property. I then find a buyer for that property. What am I saying to this buyer and telling him what he needs to do to take advantage of the opportunity zone?
Okay, so we'll assume this is completely hypothetical and has nothing to do with the real project you're working on. No, you've identified a property in opportunity zone. You want to do something with it. You know somebody who's got some money who would like to take advantage of the property for a development for their own purpose or because they want to take advantage of the tax incentives. So you would essentially approach them and say, why don't we work a project here where you will come in, you will set up the Opportunity Zone Fund, they will invest into the fund will then either start a property development business, which will develop the property, or directly invest into the property itself. And you want to look at what you want to do with the property over time and what does the investor want to do. So at that point, you're essentially lining up like a developer, all the different players, You're going to say, here's my contractor, my general contractor, here's this person, who I need, and here's the money person. And if they have enough capital gains, then this would be one of the ways for them to get the greatest return on their investment, is to roll it into a long-term patient capital through this investment fund. And you would,
Sorry, just one note on that. It's been shown that there's something like $7.3 trillion of unrealized capital gains just in the stock market alone. And the way things are going,
This week.
it's inevitable that we're going to see a drop in the market. We've always felt that there's going to be a tremendous amount of people that are looking to take their money out of the stock market in the next 2 years and put it into something that will not only hold its value but reduce the capital gains liability that they'll owe, as well as eliminate any liability on the upside of the appreciation of that project or business. So really what we're doing here is we're identifying these projects or opportunities or properties or businesses and waiting for these investors to come this way, because all we have to do then is put the opportunity fund in place and connect it all.
yeah, so and to supplement, that is, you've got a property, you've got an investor. You're put on your developer hat and figure out who are my tenants going to be, what is the property going to be, how much money is required, who's going to do the building, can John help me find a back-end lender or different types of lenders, and you frame it and you talk to everybody in the group, assuming everybody's acting in good faith and so forth, and say, here's what I'm thinking. I typically will create a concept paper and circulate it and go, is this, everybody in agreement? If everybody agrees, then we go 1 or 2 more layers of detail deeper, so I make sure everybody's clear that we're all using the same game plan. And if everybody says yes, then I go, okay, on this day you do this day you do this, and on this day you do this, but you're going to create a fund, you're going to move the money into the fund that qualifies the capital gains rollover. That money has to be invested within 6 months into a business or to a property. If it's into the business, they then have 30 months in which to deploy that money into development of the property. So you get a longer runway, and that's typically what most people are going to do. You need to have your use of proceeds defined before you take the money, so that if they're checking, they know that how you're going to spend the money. And with that in hand, you've got a brand new project with a custom team for that group. Everybody has their different role, and you can tell them that at the end of 10 years, if this property appreciates to this value, we're going to liquidate the property, and this is what you get, and you get, and you get, and you get along the way. If you have people coming in and out of this as a general contractor, then this is their fees that they're going to get, which is a cost towards the project. We would, right now, in a lot of these projects, we're asking the general contractor if they would front the money to put together some of this infrastructure, the fund and other things, in order to be the designated supplier of the services, because they should make enough money out of the project that.
Okay, I can obviously take a commission on the sale of the asset. Can I participate in the fund?
I'm sorry.
So as the real estate broker, by brokering this transaction, I can take a real estate commission out of it and make money in the front end of this deal. Can I take a piece of the fund as well, the Qualified Opportunity Fund?
No.
Is there any restriction on that?
Yes, because you're only allowed to roll over capital gains. So your services as a broker, ordinary income, you can't roll that over. Now, if you made enough money from your fees over here and you happen to have an investment over here where you did have capital gains, nobody's doing this dollar for dollar matching. You can roll those capital gains over while you're earning your fee over here. So we've had some interesting conversations with people borrowing against things and doing other things that where they did realize a capital gain, but they didn't have cash. So they can play with their assets in order to put themselves in a position to actually put that capital gain to work in an investment.
And then I don't want to sound completely mercenary, but obviously I can realize a commission. Is there anything else in the structure we've spoke about where I can participate financially in any of the rest of this transaction?
You may be able to participate without getting an opportunity zone tax incentive. So you can have opportunity zone investment side by side with ordinary investment. So as being part of this project, you might take a carried interest in the business that's not an opportunity zone style investment that allows you to participate in the appreciation of this project, but you're not going to get the tax benefits at the end as a consequence of that. Yes.
Question. I bought a property 2 years ago. It was vacant land. Okay, and it was
Bad timing. No, just kidding.
And it was just sitting there. And I figured, okay, let's go ahead and develop this land. So what I did was I sold an asset for the capital, and I'm going to there's capital gains. So if I create a fund, I could put that capital gains into that fund to develop this piece of land.
Right.
Okay.
This is a land in an opportunity zone.
Right.
It is.
Okay. I have another asset that, because of the development cost, it's going to require me to sell another asset. Do I need to create two funds, or can I just put that into that?
As long as you're in the same 6-month time frame from both liquidations, you sold one and recognize the capital gain, you got 6-month clock ticking.
Right.
You sell another asset, you got another 6-month clock ticking. You want to make sure that there's an overlap between those 2 times to make your investment. But you can make both of those into a single fund. Oops, that was good. The state of Colorado created this matchmaking site, which is, this is the site. You'll get this on the slide deck, so you don't have to worry about writing it down. It's also in the guide. But this is online. It just started a couple weeks ago. You're allowed to post both opportunities for investment, people seeking money, plus people who have money looking for investments. There is a caption at the bottom of the form that says that you must be legal in making a disclosure of the investment that you're trying to raise money, because if you're engaged in a private offering, publishing on this site is not private by its definition. We're working on some workarounds on this right now. We may go back to them and ask them to allow you to put in a little bit of information that is an announcement that you're raising money without it being an offering. We'll see how that works. You also can do a crowdfunding campaign in Colorado, so if it's under $600,000, you could register for a public crowdfunding and post on this site and still do a private offering at the same time. So there are some workarounds, just to let you know. Okay, then that gets us to the end of the program. This is the new library that's being built. This is our Meetup site. If you're not a member of this group, please join. The more people that join, the easier it is for me to get a sponsor to step up for the group. Please get your entire friends, family, every employee of your business, all your associates to sign up as well. We get over 10,000 people. It'll be easy for me to get a sponsor. Yeah, if you want to check out information, we'll be continuing to add to the site. So with that, we're going to call it a wrap for this evening. Thank you all for coming, and I'll be happy to take some more questions after the program tonight. Thank you.